Last week, I ran Hub Group through 5 distinct valuation models and 2 legendary investing checklists. And honestly, what I found shocked me. It's absolutely crazy how a massive, headline-grabbing accounting scandal can act like a thick smokescreen, completely obscuring the underlying reality of a stock. When you actually look at the raw data, it makes you wonder if this $2.5 billion company is a misunderstood hidden gem just waiting to rebound, or if it's literally a logistics train wreck about to derail your portfolio. Stop what you're doing. If you own HUBG, or even if you're just thinking about buying the dip, you need to hear this. This company recently dropped an absolute bombshell on the market, a shocking $77 million understatement in purchased transportation costs and accounts payable. For most of us retail investors, this is the ultimate nightmare scenario, right? You wake up and the financials you've been relying on are suddenly deemed inaccurate by $77 million. Obviously, panic is the natural response. But hang on. Here is a wildly surprising number for you to chew on: 7. Despite this catastrophic accounting error that triggered a whole wave of securities fraud investigations, Hub Group still maintains a rock-solid Petrosky F-score of 7 out of 9. That is a strict checklist measuring pure financial health. So the underlying fundamentals of the business are actually screaming strength, while the news headlines are screaming danger. It's totally possible this stock's intrinsic value is completely detached from the current market panic. So that leads us to a massive, bold question. Is HUAG a classic Warren Buffett buy, where we should be greedy when others are fearful? Or is this a dangerous Peter Lynch trap, where we're basically just trying to catch a falling knife? Look, I know the biggest fear for any retail investor is buying into a stock right before a regulatory disaster completely wipes out your position. You want clarity, not chaos. And by the end of this explainer, you are going to know exactly where this stock stands. I'm giving you a clear, actionable framework you can steal today. Step 1, we analyze the bust itself. Step 2, we run 5 specific valuation models. And Step 3, we apply the Buffett and Lynch checklists to get our final verdict. Let's get right into it. All right, Step 1, the business and the bust. Let's take a quick look at Hub Group's supply chain. Before we judge the numbers, we really have to understand the machine. Hub Group is a $2.54 billion intermodal and logistics giant with a pretty massive legacy. Philip Yeager founded it back in 1971 in a windowless room above a flower shop with just $10,000. They grew exponentially and went public in '96. More recently, they aggressively expanded by scooping up chop tank transport and taggage logistics in 2021 and 2022. But that incredible growth story just slammed right into a brick wall in 2026, with a delayed Form 10-K filing and a formal deficiency notice from NASDAQ. To grasp the gravity of that NASDAQ notice, we have to look at the bust itself. Hub Group announced a restatement of their financials. Basically, they found an error that understated their purchase transportation costs and accounts payable for the first 9 months of 2025. Guys, when a logistics company understates transportation costs by $77 million, it means their past profit margins were likely artificially inflated. They literally didn't realize how much they were actually spending to move freight. Now, consider the corporate response here. CEO Phil Yeager stated that accuracy and transparency are of the utmost importance, and they're actively enhancing their processes. But here's the kicker. He made this statement at the exact moment multiple prominent law firms, we're talking Lowy Dandenberg, Pomerantz, Levi and Korzinski, are launching aggressive investigations into possible federal securities law violations. The contrast between this calm internal messaging and the external legal reality is, well, pretty stark. Okay, moving to Step 2. Our 5-model fundamental breakdown. It's time to actually look under the hood. Right off the bat, the price-to-earnings ratio sits at 23.88. Honestly, for an asset-heavy logistics company facing an accounting scandal, paying nearly 24 times earnings isn't exactly what I'd call deep value territory. But the metric that really stands out is the return on invested capital, or ROIC, sitting at a remarkably low 4.71%. This tells us that right now, management is seriously struggling to generate efficient returns on the cash they're deploying. And with a free cash flow yield of just 2.36%, you really aren't getting paid much to sit around and wait out this storm. Let's pull back a bit and look at the enterprise valuation ratios, which factor in the company's debt and cash. It paints a totally mixed picture. The EV to EBITDA ratio is a fairly reasonable 8.77, but looking closely at their cash flow, the EV to free cash flow ratio is a staggering 48.66. When you have a ratio approaching 50, the market is essentially pricing in this massive future cash generation capability that, frankly, the company just isn't demonstrating right now. So, despite all that, the most crucial point might just be this number right here,
3.83. This is Hub Group's Altman Z-score. For those who might not know, the Altman Z-score is a formula used to predict the probability of a company going bankrupt within 2 years, with anything above a 3 considered the safe zone. So, purely mathematically speaking, despite the $77 million accounting drama and those looming lawsuits, Hub Group is actually very far from bankruptcy risk. They definitely have the financial architecture to survive this hit.
And the underlying business strengths really support that survival thesis. Even amidst all this chaos, their Q4 intermodal volume actually increased by 1%. They're sitting on a really solid balance sheet with $140 million in cash and restricted cash. They even managed to decrease their net debt by $50 million, bringing it down to roughly $116 million. Oh, and they're still returning capital to shareholders with a 50-cent annual dividend. Basically, the engine is still running, even if the dashboard is totally broken. Which brings us to step 3, the verdict. Let's run the Buffett and Lynch checklists. We've got a financially stable business that's deeply entangled in a messy operational failure, so let's weigh the evidence. First, who actually owns this thing? Institutional ownership is massive, reported at over 100%, which usually just happens because of short selling and reporting delays. But look closely at that short interest. Nearly 5% of the float is sold short. That's a notable chunk of traders actively betting against the company's recovery, likely assuming these accounting restatements are going to reveal even deeper problems. Now for a very painful red flag, especially if you're trying to follow Peter Lynch's advice. Lynch famously said, insiders might sell their stock for any number of reasons, but they usually only buy for one. Well, right in the middle of an accounting restatement and a delayed 10K, CEO Philip Yeager sold 32,000 shares on the open market for an estimated $1.39 million. I mean, seeing the captain sell off a huge chunk of his stake while the ship is taking on water, that's a really tough pill to swallow. So let's weigh the trades directly against each other. On the Warren Buffett side, you've got strong survival metrics. We're talking an Altman Z-score of 3.83, a high Piotrowski F-score of 7, and a deeply established, hard-to-replicate logistics moat across North America. But on the Peter Lynch trap side, the evidence is pretty heavy. You've got a $77 million accounting restatement, multiple legal investigations, poor capital efficiency with that 4.71% ROIC, and of course, heavy insider selling at the top. Ultimately, it comes down to what kind of investor you are. The data is super clear. Hub Group isn't going bankrupt anytime soon, but the road ahead is completely paved with legal fees, compliance headaches, and a desperate need to fix their internal reporting. So I'll leave you with this. Are you willing to stomach the severe regulatory risk for potential turnaround play? Or is this a supply chain train wreck just waiting to derail your portfolio? The numbers are all there, but the decision is entirely yours.